US regulators halt operation as federal shutdown paralyzes financial oversight. The United States entered a new phase of political and economic turbulence on Wednesday as financial market regulators began shuttering operation amid a federal government shutdown following Congress's failure to secure a funding extension. The Securities and Exchange Commission, which supervises thousands of listed companies and funds, confirmed it will furlough more than 90% of its workforce, retaining only 393 staff members for emergency enforcement and market surveillance. Routine corporate filings will continue, but the agency warned that initial public offering and pending approvals of cryptocurrency exchange traded funds, including anticipated launches tied to Solana and XRP, will face indefinite delays. Similarly, the Commodity Futures Trading Commission announced it will operate with just 5.7% of its staff, focusing narrowly on preventing fraud and abuse in derivatives market. Analysts cautioned that this skeletal oversight could leave US financial markets vulnerable at a time of rising global uncertainty. Markets reacted nervously. Wall Street futures dipped, the US dollar weakened, and gold surged to a record high, reflecting investor unease. While past shutdowns have had limited financial repercussions, experts warn that a prolonged standoff could erode investors' confidence, disrupt economic data releases, and dampen the fragile IPO revival. The shutdown has immediate effect of undermining investor sentiment, with the long-term risk of clogging the IPO pipeline, noted Samuel Kerr, head of equity capital market at the merger market. As the impasse drags on, the paralysis not only highlights deepening partisan divides in Washington, but also threatens to reverberate across global market, positioning the US once again at the center of financial instability with geopolitical consequences.